Most people can't explain exactly why money feels harder to make in 2025. They only know the feeling: working more hours but saving less, earning more income but having less left over, doing everything right and still falling behind. And that feeling isn't an illusion. It's not a mindset issue. It's not a lack of ambition. It's the result of a structural economic shift that most households sense long before economists acknowledge it. When the cost of living rises faster than wage growth, when credit becomes expensive, when essential expenses outpace income, and when the financial system becomes less forgiving, earning money doesn't just become difficult, it becomes systematically constrained. The frustration people feel in 2025 is simply the surface-level symptom of deeper forces quietly reshaping how income, opportunity, and financial mobility work in America. One of the most important forces behind this shift is the widening gap between wage growth and inflation over the last several years. While inflation cooled on paper, many of the price increases that occurred from 2020 to 2023 became permanent. Rent didn't fall back. Food prices didn't return to pre-pandemic levels. Childcare, insurance, utilities, and transportation costs remained elevated. At the same time, wage growth slowed sharply after 2022. This created a structural imbalance where incomes didn't adjust back upward even though everyday costs had permanently changed. The mathematics of life became heavier. And when fixed expenses take up a larger share of income, it automatically feels harder to make money, because the money earned disappears faster. Another reason money feels harder to make is the rise in price volatility. Even if overall inflation is reported as moderate, households don't experience inflation as an average. They experience it through the categories they interact with most. Food inflation remains high compared to pre-pandemic norms. Insurance premiums have risen dramatically, especially auto and health insurance. Energy costs fluctuate unpredictably. While wages remain stable, essential prices do not. This inconsistency creates a psychological sense that money is unstable. It drains confidence. When people lose confidence in their purchasing power, earning the same amount of money feels less meaningful because its utility is weaker and less predictable. Credit markets have also shifted in a way that makes money harder to earn and harder to keep. For more than a decade, Americans became accustomed to historically low interest rates. Borrowing was cheap. Credit supported lifestyles, small businesses, home purchases, and personal upgrades. But in 2025, borrowing is expensive again. High interest rates mean that credit cards accumulate interest faster. Personal loans cost more. Auto loans have become significantly more burdensome, especially for lower credit tiers. Mortgage payments have increased dramatically for new buyers. Credit, which once acted as a financial buffer, now acts as a financial drag. Instead of helping people extend income, it reduces future income through compounding payments. This makes the process of earning money feel heavier, because a portion of every dollar earned is already committed to financing costs that didn't exist at the same scale a few years ago. At the same time, job markets have shifted in ways that reduce income mobility. While unemployment remains statistically low, the quality of available jobs has changed. Competition has increased for high-paying positions. Hiring has slowed in many sectors. Companies have become more selective, using automated screening tools that reduce applicant visibility. Remote work opportunities have contracted. Wage increases for switching jobs, a major driver of income gains in past years, have normalized. People often find themselves working just as hard, yet not seeing upward salary progression. This creates a sense that money is harder to earn, because the pathways to higher-paying roles have become narrower and more competitive. The labor market is also experiencing a subtle but important shift. Productivity expectations have increased without corresponding pay adjustments. Many workplaces now expect employees to handle higher workloads, adopt more digital tools, and maintain constant availability due to remote and hybrid work habits. But wages did not rise proportionally with these rising expectations. In practice, people feel like they are working harder but earning the same, or sometimes less when adjusted for inflation. This mismatch between effort and reward contributes heavily to the perception that money is becoming harder to make. Another structural force is the shrinking value of savings. High inflation years eroded the purchasing power of savings, while high interest rates increased the cost of debt, creating a double pressure. For many Americans, The financial cushion they once relied on has weakened. With less savings and more expensive credit, every new financial challenge feels heavier. When people have limited financial margin, the effort required to earn and maintain money feels significantly greater. Small businesses and freelancers also face stronger headwinds in 2025. Higher borrowing costs reduce the feasibility of expansion. Consumer demand is uneven. Operational costs are elevated. Payment delays from clients are more common. Platforms and marketplaces have increased fees. Regulations have become more complex in various sectors. All of this makes independent income less stable and more difficult to grow. Even highly skilled professionals feel the pressure as competition increases and clients become more cautious with spending. One of the most overlooked reasons money feels harder to make is the decline in upward mobility. For much of modern economic history, it was reasonable to expect that working hard would lead to improved circumstances. But the cost structures of education, housing, healthcare, and living expenses have outpaced wage growth for more than a decade. Upward mobility still exists, but it requires navigating a tighter, more competitive environment. And when mobility slows, motivation suffers, making the process of earning money feel more draining and less rewarding. Technological disruption adds another layer to the challenge. Automation, AI, software optimization, and digital tools have reduced the number of mid-skill jobs that traditionally offered stable upward paths. Companies are increasingly adopting technology not just to enhance productivity, but to reduce labor costs. This shift doesn't always eliminate jobs outright. It often reduces opportunities for advancement. Employees who could previously climb into supervisory or mid-management roles now face flatter organizational structures. With fewer promotion opportunities, income progression slows. The U.S. housing market adds additional pressure. High home prices and high mortgage rates have pushed ownership out of reach for millions of families. Renting has become more expensive with no long-term financial return. Real estate once served as a primary wealth-building tool for the middle class, but in 2025, many feel locked out of that pathway. When major assets become unattainable, the effort to earn money feels less purposeful because people feel unable to convert income into wealth. Another reason money feels harder to make is the psychological fatigue created by years of financial volatility. Economic shocks, from the pandemic to inflation spikes to political tension to global uncertainty, have eroded financial confidence. Even when people earn more money, their sense of security hasn't increased. The lack of stability makes every financial decision feel heavier. When the economic environment feels unpredictable, people view their income as fragile, even if their job is stable. The digital economy also contributes to the problem. Online spending convenience increases impulsive purchases, subscription stacking, and microtransactions. Many households underestimate how much they spend because payments have become frictionless and automated. Without clear mental accounting, money feels harder to manage and therefore harder to retain. When retention drops, earning feels less effective. Healthcare costs amplify financial pressure as well. Insurance premiums, deductibles, and out-of-pocket expenses have increased substantially. Even individuals with good salaries experience financial strain from medical costs. These expenses are unavoidable and often unpredictable, creating another layer of financial weight that reduces the effective value of earned income. Meanwhile, the expectations placed on individuals for self-management of retirement, insurance, and investment have increased. Pension systems are mostly gone. Social security confidence is weaker. Individuals are expected to plan for and manage long-term financial risks on their own. This shift creates anxiety and increases the perceived difficulty of achieving financial security, feeding the broader feeling that money is harder to earn. All these pressures, wage stagnation, inflation stickiness, credit tightening, reduced mobility, rising costs, psychological fatigue, and systemic volatility, combine into a single lived experience. People feel like their effort is no longer producing the same outcome. The relationship between work and financial progress has weakened, not because people are less capable, but because the economic structure around them has changed. Money hasn't simply become harder to earn. The world has become harder to afford. The sense that money is harder to make in 2025 becomes clearer when you look at how financial risk has quietly shifted from institutions onto individuals. For most of modern economic history, Large parts of financial security were shared burdens. Employers provided pensions. Governments absorbed major healthcare costs. Banks took responsibility for safe lending practices. Companies offered long-term employment paths. But over the past 2 decades, especially after the 2008 crisis, there has been a slow, silent transfer of responsibility. Today, individuals carry the weight that institutions once held. And when individuals take on institutional risks, everyday life becomes financially heavier. Take retirement, for example. Traditional pensions, guaranteed lifetime income after decades of work, were once a foundation of middle-class security. Today, pensions are rare outside the public sector. Most workers rely on 401k plans, IRAs, or personal investments. But these accounts shift all investment risk to the individual. If markets underperform, the burden falls on the household. If contributions are interrupted due to job changes or economic pressure, the burden falls on the household. If medical emergencies or unexpected events force withdrawals, the consequences fall on the household. This shift makes earning money feel harder because income is no longer just for today. It must fund decades of future vulnerability that pensions once covered. Healthcare follows a similar pattern. Insurance premiums, deductibles, and out-of-pocket medical costs have climbed for years. Employers offer coverage, but the worker shares more of the cost than ever before. Even with insurance, a single medical issue can result in thousands of dollars in expenses. This financial exposure drains savings, increases stress, and forces families to allocate more income to unavoidable costs. When essential expenses rise disproportionately, income feels less effective. It's not that people are earning less. It's that their earnings stretch less because essential costs absorb a larger share of every paycheck. Housing is another structural pressure that reshapes the sense of financial difficulty. Home prices accelerated faster than incomes throughout the early 2020s. Mortgage rates, driven upward by monetary policy, created another layer of challenge. Renting, once the flexible alternative, also became more expensive. Many families now spend 35% to 50% of their income on housing alone. When one expense consumes such a large portion of income, making money feels harder not because earnings dropped, but because the margin for savings, investment, or lifestyle improvement has collapsed. Housing used to be an opportunity. For many in 2025, it has become an anchor. Another reason money feels harder to make is the tightening of economic opportunity. Over the last decade, market concentration increased across multiple industries. A small number of large companies now dominate technology, retail, logistics, banking, media, and entertainment. This dominance limits job mobility, reduces wage competition, and flattens growth paths. When fewer companies control more of the economy, there are fewer channels through which individuals can advance. This structural consolidation means that even highly skilled individuals often feel stagnant because the pathways that once existed have narrowed. The economic ladder has not disappeared, but its rungs have stretched further apart. Credit tightening also plays a significant role. For years, easy access to credit allowed households to compensate for slow wage growth. Credit was the bridge between income and lifestyle. But high interest rates changed the environment. Now, credit is expensive and harder to qualify for. For many households, credit is no longer a tool that extends earning power. It is a burden that reduces it. High-interest consumer debt pulls future income into the past. Instead of supporting progress, debt repayment constrains progress. When a portion of every paycheck is already committed to interest, the remaining money feels smaller, regardless of how much is earned. The labor market, while still functioning, has structurally changed in ways that make earning money harder. Many companies have embraced automation, digital tools, and efficiency systems that reduce the need for mid-level roles. Tasks that once required teams can now be performed by a combination of software and fewer employees. This doesn't always eliminate jobs immediately. It slows job creation and limits promotion opportunities. When internal mobility slows, incomes stagnate even if the employee's workload grows. This mismatch between effort and financial reward is one of the most powerful psychological contributors to the sense that earning money is harder. Job security has also changed. Permanent roles have gradually been replaced by contract, gig, temporary, and project-based arrangements. These roles offer flexibility but lack stability. They often come without benefits, health coverage, paid leave, or long-term guarantees. This structural shift means that income is less predictable. When income becomes inconsistent, people feel pressure even when they are earning the same amounts annually, because the timing is unstable. Financial security is not only about how much money one makes, it is about when and how reliably it is received. Uncertainty makes income feel fragile. Another overlooked reason money feels harder to make is that digital life increases spending faster than people realize. Subscription models, microtransactions, delivery fees, online shopping, streaming services, and app-based convenience create constant financial leakage. The amounts are small individually, but they compound quickly. Most households underestimate how much they spend digitally. The frictionless nature of modern spending erodes savings without the emotional resistance traditional purchases once triggered. When money disappears without feeling like it was spent, people feel as if earning is harder because they see less evidence of progress. Inflation dynamics also increase pressure in indirect ways. Even when inflation slows, businesses maintain elevated pricing to protect margins. Shrinkflation, smaller quantities for the same price, reduces consumer purchasing power without appearing in headline numbers. Service fees increase. Utility surcharges increase. Insurance premiums rise systematically. These small increases accumulate into noticeable financial heaviness. Wages, on the other hand, adjust slowly. This delay creates a long-term mismatch between income and cost structure. The mismatch is subtle but relentless. The global economic environment intensifies these pressures. In 2025, international uncertainty, geopolitical tension, shifting supply chains, and changing global demand affect domestic financial conditions. Companies respond by becoming more conservative. They reduce hiring, delay raises, postpone investments, and manage risk more aggressively. These internal adjustments reflect external uncertainty but create domestic financial constraints. Households feel these constraints through reduced opportunities, slower wage growth, and tighter financial conditions. Technological disruption also increases income pressure through competition. Many industries face global competitive labor pools due to remote work expansion. Workers now compete with talent from multiple countries simultaneously. This reduces wage bargaining power in certain sectors while heavily rewarding others. The uneven distribution of technological opportunity means that even talented individuals may feel stagnant if they are in roles that automation or global competition suppresses. This divergence reinforces the perception that earning money is harder because the playing field is more unequal. Psychological fatigue is another major factor. The last several years have included pandemic disruption, inflation spikes, interest rate shocks, political division, market volatility, and global tension. Humans are not designed to deal with continuous uncertainty. Financial decisions feel heavier. Risk feels scarier. Saving feels harder. Spending feels guilt-ridden. Even when actual income increases, people do not feel wealthier. They feel more cautious. This caution creates a sense that money is harder to earn because emotional energy is drained. Financial fatigue is real, and it changes how income is perceived. The social environment amplifies this. Expectations have risen while conditions stagnated. People compare themselves to social media lifestyles that are not financially typical. This creates pressure. Before digital comparison, people judge their progress based on real environments: neighbors, co-workers, family. Now, people compare themselves to curated lives that distort financial reality. The gap between expectation and reality makes money feel inadequate, regardless of income level. As lifestyles become more expensive, even unchanged salaries feel smaller. The things people consider normal today, smartphones, streaming, travel, eating out, online shopping, digital convenience, weren't essential costs 20 years ago. Modern expectations require more financial resources. It's not that today's workers are earning less. It's that the financial definition of a normal life has expanded. Income hasn't kept pace with lifestyle inflation. Another reason money feels harder to make is reduced financial resilience. Savings buffers shrank after years of inflation and economic stress. Without savings, every financial issue becomes urgent. With high interest rates, borrowing cannot easily cover shortfalls. This creates a cycle of financial vulnerability. When each paycheck feels critical, the act of earning becomes emotionally heavier. All these forces, structural, economic, psychological, technological, accumulate into one lived experience. Earning money in 2025 doesn't feel like gaining ground. It feels like catching up. The economy no longer rewards effort the way it once did. Work no longer guarantees mobility. Income no longer guarantees stability. Progress requires navigating a complex environment where costs rise faster than wages, risks fall on individuals, opportunities narrow, and financial conditions tighten. Money feels harder to make because the system around money has changed faster than incomes have. The final reason money feels harder to make in 2025 is that the economy has entered a transition period where the rules that defined the last 30 years no longer apply. For most of the modern era, economic growth was supported by low interest rates, expanding globalization, stable supply chains, manageable debt costs, and predictable wage structures. People built careers, businesses, and lifestyles around these conditions. But those underlying conditions have shifted, and the shift has been so gradual that many haven't fully recognized how different the financial landscape has become. When the fundamentals change, but habits stay the same, the result is friction. People feel like they're running harder without moving further because the ground beneath them is not the same ground their parents or even their earlier selves stood on. Consider globalization. For decades, companies outsourced production to reduce costs. This expanded international trade, lowered prices, and supported consumer purchasing power. But geopolitical tensions, supply chain disruptions, trade disputes, and national security concerns have reversed parts of that trend. Reshoring and friendshoring, bringing manufacturing closer to home, are strategically important but more expensive. Higher production costs pass through to consumers, and businesses adjust by raising prices or reducing hiring. These adjustments elevate the cost of goods and reduce income mobility. People sense this change not through policy announcements, but when everyday items become more expensive and income feels stretched. Money doesn't buy as much because the global system that once made things cheap no longer functions the same way. Technology adds another layer to this shift. Automation and AI have increased productivity but disrupted income structures. While technology creates new high-paying roles, it eliminates or compresses many mid-wage roles. This polarization means that a small group of workers experience rapid income growth, while many others see stagnation. The middle of the wage distribution, the area that once offered steady, rising incomes, has weakened. This hollowing out makes the average worker feel like advancement requires extraordinary skill jumps rather than steady improvement. When the middle shrinks, financial upward movement becomes harder even though the economy continues to grow on paper. The cost of entering many professions has also increased. Education expenses, tuition, housing, books, licensing have far outpaced wage growth. Many careers that once offered high returns now require years of debt repayment before financial progress begins. Even well-paying jobs start with a negative balance sheet. This front-loaded burden makes the process of earning money feel slower because early income is consumed by obligations. In previous generations, earnings began to accumulate earlier in life. Today, they often begin after years of catching up. Financial markets have changed as well. Markets that once offered predictable returns through savings accounts, bonds, or conservative investments now move in more volatile patterns. High inflation years weakened the real value of savings. High interest rates increased borrowing costs, but did not restore the stability of low-risk returns. These dynamics make it harder for individuals to build wealth through traditional methods. The sense that money is harder to make is connected to the reality that wealth-building methods require more risk than they once did. And when risk increases, people feel insecure even when their incomes rise. Tax structures add another layer. While tax rates may not have risen dramatically, the cost of living has. When wages fail to keep pace with prices, effective tax pressure feels higher because people retain less discretionary income. The combination of stagnant wage growth, high fixed expenses, and tax obligations creates psychological weight. People feel as though each dollar earned disappears before it delivers value. The feeling of diminished effectiveness makes income feel harder to obtain because the emotional reward of earning is weaker than before. The social environment also influences financial perception. Social media amplifies wealth displays, lifestyle upgrades, and financial success stories from a minority of people. This skews perception. Even if someone is doing well financially, constant exposure to curated images of extreme wealth creates the illusion of falling behind. The distance between real life and perceived normal life expands. This leads to dissatisfaction even when income is stable. When people feel behind, they internalize the belief that money is harder to make because the benchmark for enough shifts higher. Generational expectations contribute to this feeling. Older generations built wealth in an environment with lower home prices, lower education costs, stronger job stability, and lower healthcare expenses. Today's workers operate in a different system. High cost of living, higher debt burdens, sharper competition, volatile markets, and reduced economic safety nets. Comparing outcomes between these two environments creates frustration. People feel like they must work harder to achieve less because, in many ways, they do. Effort has risen, but the economic structure has made progress slower. The psychological toll of uncertainty also shapes how earning money feels. When people experience multiple years of economic shocks, pandemics, inflation, rate hikes, geopolitical conflict, they operate in a constant low state of financial alertness. This chronic stress alters how people view income. Instead of money feeling like a tool for growth, it feels like a shield for survival. When money becomes defensive rather than empowering, earning feels heavier because the emotional meaning of income changes. What once felt like progress now feels like protection from risk. Another factor is the erosion of financial slack. In the past, families had more flexibility, lower debts, lower housing costs, more stable benefits. This slack allowed for mistakes, unexpected expenses, and lifestyle upgrades. But with higher fixed costs and tighter budgets, households have less room for error. When a single unexpected bill can disrupt an entire month, the effort required to maintain stability feels enormous. Money feels harder to earn not only because of costs, but because the margin for error has disappeared. Modern financial life has less cushion. Even the way people work has changed. The expectation of always being reachable, always connected, always performing at near maximum capacity contributes to burnout. Burnout reduces productivity, motivation, and financial resilience. When people are mentally and emotionally exhausted, they perceive their earnings differently. A paycheck earned through exhaustion does not feel like success. It feels like recovery. The emotional return of money shrinks, making the process of earning feel harder. Economic narratives also influence perception. When the public hears conflicting messages, the economy is strong, but people are struggling, it creates cognitive dissonance. People trust what they feel, not what they are told. And what they feel is that progress is harder. When data doesn't match lived experience, people lose confidence in institutions and rely more on their day-to-day reality. That reality, for many, is a sense that money does not stretch as far as it once did. But the most important truth is this: money feels harder to make in 2025 because stability has become more expensive. Stability requires savings, insurance, housing security, reliable transportation, strong credit, manageable debt, emergency funds, and predictable income. But each of these components is more difficult to secure than it used to be. When stability becomes expensive, financial life feels unstable even when income rises. This compounds the feeling that money must be chased constantly. Despite all these pressures, there is another side to the story. Understanding the forces behind this shift gives individuals the opportunity to adapt. When people understand that financial difficulty is not a personal failure, but a structural environment, they can make decisions that align with the new reality rather than relying on old assumptions. Adapting doesn't eliminate the pressure, but it creates clarity. And clarity reduces fear. Money feels harder to make in 2025 because the economy has entered a new era, one where costs rise faster than wages, risks fall on individuals, mobility slows, and uncertainty persists. The rules have changed. The pathways have shifted. The environment is different. But understanding the difference is the first step toward navigating it. The frustration people feel today is real. The pressure is real. The gap between effort and outcome is real. But so is the opportunity to rethink how money works in this environment. When people understand the forces shaping their reality, they can begin to regain control. The challenge is undeniable, but it is also navigable. Money hasn't become harder to earn because people lost ability. Money has become harder to earn because the system around money evolved, and individuals are still catching up to the new rules.